Welcome to the latest episode of Quest for Toys. In this episode, I'm going to review updates from several companies I invest in. So the first one is Amazon.com. So in the latest quarter, Amazon sales went up by 15% from 1 year ago. However, its operating income came down by 22%. Due to cost increases that's faster than the sales increase. And the cost was from a higher labor cost and higher logistics costs. So on surface, that's bad news, and the Amazon stock was punished because of the lower operating income and earnings. So according to Amazon, the sales are no longer physically constrained by the amount of a warehouse and the fulfillment center. Instead, the sales are labor constrained. They cannot find enough people to make the sales, to fulfill the orders, and to deliver the orders. So in that context, I consider the higher cost Amazon spent in this quarter and Q4 as an investment in customer relationship, because Amazon has the goal to have inventory and fast delivery during the holiday season. And that's going to increase the customer satisfaction, especially in the context of a shortage in the broad economy and supply chain bottleneck. So I believe Amazon will beat its competitors in terms of having goods available and be able to deliver when the customers want them. Like the customers have used to the 2-day delivery, and Amazon has been building its capabilities to satisfy that. So since the higher cost is considered as an investment, I'm not really too worried about the temporary impact on the operating income. Now, let me review the year-on-year sales growth by segment. So the online third-party sales and the physical store sales are going back to normal. We could see in this chart the sales growth in the last 2-3 years. And the peaks and the valley impacted by the pandemic is reverting to normal. With that context, I would say that the growth is decelerating for its sale of the goods sales. But the current investment should drive future growth with its increased fulfillment and warehouse facilities, as well as additional investment in labor. So I believe in the coming quarters and years, Amazon, the e-commerce volume will still steadily grow, just not as fast as during the pandemic. Its ad sales are also going back to normal. According to the Amazon's executives, the ads, online and third-party sales are really integral parts of a single system, because good amount of buyers and sellers on its platform. Once it grows, then it'll attract third-party vendors to increase their advertisement spending for to help the buyers to find their products. So it's not surprising that its ads growth is also going back to normal as before the pandemic, which is still very strong as of above 40%. The Amazon Web Services, AWS, is still going strong. It actually slightly increased its growth rate compared to the slight dip during the pandemic. And its subscription sale is moderating, but I wouldn't say it's anything that's alarming. So let me quickly review my original investment thesis and the risks. So the thesis was to buy a growth company at a reasonable price, which I think that's still valid. The gross margin has been pressured because of the bottleneck and in terms of labor and logistics, but it should dissipate in the coming quarters and years. The risks are Microsoft or Google take market share away from AWS. In the latest quarter, Microsoft grew faster than AWS in terms of cloud services. However, AWS is still growing very fast and with a much larger revenue. So I think it bears watching, but it's not alarming at this point. The future growth of a subscription and advertisement sales less than historical trend, which also bears watching because we do see that slowdown in the most recent quarter. The wasteful investment in mergers and acquisitions as well as R&D, yeah, that's a risk and will need to be monitored continuously. But really, there is no update. And the antitrust litigations, and there is no update either. So at the current price to sale ratio of 3.72, it actually came down slightly compared to August. And that's 10% higher than the average prior to COVID pandemic. So short-term pullback are possible, but because of the entire market is relatively frothy, so I think the slight elevation compared to the historical average is okay. It's not a big bargain, but I would say it's a reasonable price, and its growth story still has legs to go. Next, a quick update on INMD. So on the left, I plotted the trailing 12-month revenue at several points in time. And those are the brown bars in the left graph. So INMD reported its latest earning, and its revenue has been growing very nicely. So the business is doing great. I also plotted the historical price in time. We can see that there is a very sharp price increase in this year. I bought INMD stock in the summer around $54 per share. Now it's over $90 per share. INMD business has been doing great, and in the span of several months, its quarterly earning results have been growing pretty fast. However, the price increase has outpaced the increase in revenue. So that becomes clear if we look at the graph on the right. So that's a price over 12-month sales ratio. So historically, at the end of 2019 and 2020, the price over sales ratio is less than 10. But because of the recent very fast price increase, now the price over sales ratio is over 20. So the conclusion is that the business is doing great, and the investors have become very excited about this company, and they now value more for the same amount of sales. So that's a perspective help me keep an even keel and not too excited about my stock picking skill. I think it's just lucky that the investors now feel so strongly about INMD as a stock. Before I review the quarterly earnings from Ingredient, I would like to have a quick review on the greenhouse gas impact of food. So according to Bloomberg, about 15% of human-driven greenhouse gas emission comes from livestock production. That's almost the same as the contribution from the transportation sector. At this point, it seems investors are really focused on the transportation as well as the power generation sector, and not paying so much attention to the other contributors of greenhouse gas emissions. If we look at the chart on the left, beef generates a lot of greenhouse gas per 100 grams of protein. And compare that to peas protein. That's about 1% of the beef greenhouse gas footprint for the same amount of protein. So if society is really serious about getting the greenhouse gas emission under control, then really there is a really good pathway by consuming more plant-based protein and consuming less beef and other animal protein. So to play that investment thesis, we can take a look at the Ingredient as a company. So for Ingredient, its growth comes from specialty ingredients, including plant-based protein. And also, the specialty ingredients have a much higher gross margin, over 30%, compared to 21% overall for Ingredient as a company. So Ingredient has been growing its revenue contribution from specialty ingredients in the last several years, from 2015 at 25%, with the target of 35-36% 2 years from now. And in the most recent quarter, its specialty ingredients grew in high teens, comparing to 17% overall. So that's the growth story is still on track. However, it suffered a 9% decline in adjusted EPS in Q3 because of a margin compression of 340 basis percentage points. That's driven by corn price inflation in 2021. At the bottom right, I showed the corn price history in the last 4 or 5 years, and we can see that the corn price exceeded the historical average by a huge amount in 2021. The good news is that the Ingredient tends to negotiate its contracts in Q4 of each calendar year, and it has a pricing power to pass through the higher costs. So in next year, unless corn price continue its upward trajectory, Ingredient should be able to recover its profit margins. So this table make it more clear about the inflation impact. So for 2021, the Ingredient guided its revenue at about 6.8 billion. That's higher than 2020 and 2019. However, its most recent quarter, its gross margin is only 18.3%, comparing to the historical average about 21%. As a result, its adjusted operation income in 2021 will be about $650 million. That's less than $700 million in 2019, and also will be less than 2020. Also, its cash from operations will be about $500 million in this year, compared to $829 million in 2020 and $680 million in 2019. So that's significantly less. However, the main reason is because of the inflation impact on its working capital, and because of the higher current cost. Its working capital increased by over $260 million in the first 9 months of this year, and that's taking the cash away from CFFO. So if we add $260 million back to $500 million of CFFO, that's close to historical average. So let me quickly review the original investment thesis. So I believe ingredient still has attractive valuation with a modest risk, with the forward PE about 13. Its investment risk is modest, as its sales were fairly steady in the past and it generates a lot of cash. Once the current price inflation passes, then its working capital will be released, and there will be a lot of free cash flow to be used for share buybacks and paying dividends. It has a narrow moat for its specialty ingredients, and it's growing its specialty ingredients segment steadily and on track to its long-term target. So I still believe it's a good investment I plan to keep. The last one I'm going to review is Emerson. As I mentioned before, I follow Emerson because it's a good bellwether for industry companies as well as commercial and residential real estate. So this graph shows the Emerson's trailing 3-month orders compared to 1 year ago. So the key message is that the residential market is cooling. So for its commercial residential solution segment, its September underlying order is only 9% higher than 1 year ago, compared to a double-digit increase in the previous month. However, Emerson does not see a cliff coming, so it should stabilize in the coming month. Its automation market is recovering steadily. So for its fiscal Q4, its sales went up by about 7%, comparing to its guidance given during the 1 quarter ago. That's actually at the low end of the range. Also, its EBIT margin declined 10 base percentage points. Its adjusted EPS is $4.1. That includes about 19 cents impact from inflation and logistics the economy is currently experiencing. However, Emerson is fairly confident that it will be able to pass through the higher cost and recover the inflation impact in the second half of its fiscal 2022. Emerson forecasted its sales will grow about 7% from 18.2 billion in 2021. Note that the 18.2 billion is within the range Emerson gave previously for 2021. Its EPS growth will be about 10% from $4.1 in 2021. Its CFFO is forecasted to grow to $3.8 billion. And its EBITDA margin is 23% in 2021, and it should stay the same or slightly improve once the inflation pressure eases. So with this guidance, we can compare with its 2023 targets. That's a EBITDA margin of 24% and adjusted EPS between $4.75 to $5. So I believe its growth ambition is still on track. Emerson is going to grow relatively slowly and steadily. So with its current price, I believe it's fairly priced. So I will continue to keep track and monitor this company's business. But I do not see myself invest heavily into this company. So this wraps up the earning review in this episode. Until next time, happy investing.